Nilesh Shetty of Quantum Mutual Fund joins us right now on the show. Nilesh, good afternoon. Thanks so much for speaking to us at Bloomberg Quint. What is it that you're doing right now? There is a slew of announcements that the government is making to try and boost sentiment, maybe some reforms, etc. But the larger will of money doesn't seem to be in favor. Are you deploying money? Are you sitting on some bit of cash, or are you aggressively buying?
Yeah, so selectively we've got opportunity to deploy cash. Our cash levels were as high as sort of 15%. Given that the correction has not been uniform, you have had pockets of opportunity emerge. So we did allocate to the NBFC sector when they corrected sharply after IL&FS, and recently more in the auto space after you've had a significant correction given weak numbers. But again, our cash levels still remain elevated, still remains about 13-14%, which is much higher than our historical averages. If the markets were to continue to correct, then and we are happy to buy, given that we are long-term investors. Right now, again, despite the correction, you don't get that many opportunities, barring select pockets in auto and NBFC. Excluding that, you're not getting that many opportunities. So we wait and watch. If the markets were to correct, we'll be happy to buy into the market.
Right. Today, metals seem to be extremely active in relation. This has been a pocket that's probably been sidelined. Even when we made those record highs, there was not much of, of the pie that went to the metals pocket. But do you see that cycle changing now? But also keeping in mind the backdrop of the trade wars.
Yeah, sort of in the metals, there really are very few quality players. And you really are dependent on sort of what's happening in China. We really just have a small allocation there to a very highly cost-efficient player who we think will survive sort of whatever happens cyclically in the sector. But by and large, we've sort of avoided that sector, and we still do not see many opportunities there for us to deploy sort of our cash.
Nilesh, you mentioned you're sitting at 13 to 14% cash levels, which is actually on the higher side. So when you start deploying at lower levels, how much correction or what's the support that you foresee for the markets? You also highlighted only autos and NBFCs giving opportunity, but are you finding value there, considering now there is so much of chatter that auto is witnessing a structural slowdown and not a cyclical one?
Yeah, the slowdown essentially got triggered because of some regulatory changes which drove up cost for the end product, and second, the credit crunch that hit the sector post IL&FS. The crunch is not necessarily for you to finance automobiles, but essentially a lot of the demand that was being created by financing sort of loan against property and other products. People who are dependent on that for their working capital financing is what we understand is sort of impacted after the IL&FS event, which is impacting end demand for consumer discretionary in general. But again, both these factors are essentially cyclical in nature. They do not alter the structural story in auto, which is essentially low penetration across categories. Be it four-wheeler or two-wheeler. So we remain fairly bullish on the sector. For investors who are looking for to invest for the next 6 to 8 months or 12 months, it's not the time to invest. But people who are looking at sort of 3 to 5 year horizon, given where valuations are, it's very attractive if you're a long-term investor.
Okay, and where do you see the recovery coming by first? Will it be CVs, PVs, or two-wheelers?
Yeah, again, CV unfortunately is just starting into a downturn. They've had 4-5 years of a strong upturn, and perhaps, irrespective of the general economic slowdown, it looked like the CV cycle will slow down after 4-5 years of very strong numbers. So we don't expect CVs to do really well sort of this year or next year. But general passenger vehicle sales and two-wheeler sales should show an uptick if things were to normalize in the economy. Till September, actually, both at least two-wheelers were reporting double-digit volume growth, and post IL&FS, things sort of dramatically fell off a cliff. So our sense is once things normalize and you have sort of catalysts in place, this year the monsoons have been fairly decent, and the festive season demand is coming up, in lieu of the fact that there are going to be regulatory changes on the emission norms, which is going to make products more expensive sort of next year. You should expect some preponement of demand, which hopefully should sort of improve the sentiments in the automobile space. So our primary bet is on sort of two-wheeler and sort of four-wheelers, where we should expect some uptick in demand.
Right. Nilesh, one last question with regards to PSU Banks. Talks of big mergers being announced there. But would any of the banks be of any interest to you?
So we have SBI in the portfolio, but below that, what we observe is the quality of the management and government influence sort of tends to dramatically sort of destroy a lot of value in these banks. So again, merging two weak PSU banks or sort of getting two banks to merge is not a solution in that pack. The big problem is the owner and the kind of influence it wields on the lending capability of these banks and the risk assessment capability of these banks. Essentially, they are not able to do it in a free manner, which is what sort of destroys a lot of the book value in these companies and drives a lot of inefficiencies. So despite whatever sort of cosmetic changes are being planned, unless the owner reduces its influence in the bank and allows them to operate in a much more freer manner, we really sort of don't look at this pack.
We'll leave it at that. Nilesh, thanks very much for joining us. Appreciate you taking out the time.